have Kanika Pasricha, Chief Economic Advisor at Union Bank of India, joining us. And Kanika, hi, good afternoon. Thanks so much for your time. Just very recently, we've seen an S&P upgrade coming in on India's ratings and the economic outlook. Now, while the outlook has been maintained stable by Fitch, they've maintained their rating at BBB negative. They've not changed anything or made any positive change to their stance. What is your take on this rating coming in? Of course, lots of commentary that they have backed it with, but prima facie, what's your take on this rating?
So actually, thanks for having me here. Really grateful. So, see, 3 points to make. First and foremost, when S&P upgraded us, there was a lot of discussion that other rating agencies may also follow suit. Specifically, Fitch, which has been relatively stable in terms of its rating profile. I think the last time they upgraded us to investment grade was in August. It was in around 2006. While S&P last did the same for us was 2007, and then after 18 years, they gave us a positive surprise. So, two more points from our side. S&P acknowledged the fiscal consolidation roadmap, macro stability turnaround, and of course the government reforms. In fact, both monetary and fiscal policy coordination. But what Fitch is sticking on to and what they're worried about is, even though they acknowledge all these things which S&P has talked about, but they have refrained from changing our rating because they're still concerned about our fiscal dynamics and in specific about the nominal GDP growth numbers. More importantly, they believe that GST reforms may have a slightly negative impact on fiscal dynamics. And after FY26, when central government intends to consolidate deficit to around 4.4% of GDP, there'll be some stalling of consolidation roadmap. See, in our view, what Fitch is saying, the points are well taken. We are in an uncertain world. There can be some sort of glitches in terms of pace of nominal GDP growth and consolidation roadmap. But the acknowledgement of the kind of turnaround we have done in our fiscal dynamics, despite being in such a challenging global environment, and macro stability turnaround seen in the last 10 to 15 years, that should have been seen in this profile, in this rating review. If not now, maybe in the coming years, maybe in the upcoming reviews, there is likely to be an acknowledgement of the same. Thanks.
Indeed, but along with that, what Fitch is highlighting, Kanika, is the fact that though the tariffs do pose a moderate downside risk to India's growth story, but they expect the US-India tariff to be negotiated lower. Do you concur with that view?
See, actually, these are times when your guess is as good as mine. We hope that happens. 50% tariff hike implies that practically the US-India trade, even though Fitch is also highlighting is still muted at 2% of GDP, the overall macro impact may be limited. And in fact, if we take out pharma, electronics, which are part of Section 232, and we may, if the revisions don't happen there, still 1% of GDP, which is around $45 billion, does get affected by the 50% tariff hike. It means practically no trade in non-exempt items in terms of US-India trade. So while we would want to have faster negotiation of trade deal, but very important, also would want to compliment our government that national interests also need to be maintained. So maybe the negotiations, even if they take time, the ultimate outcome should be in our favor as well. Though yes, 50% will hurt, will pinch. At least let's hope and pray for a better deal as soon as possible.
Okay, Kanika, appreciate you taking the time out and speaking with us today, and thanks for sharing your thought on this rating.